Welcome to Skilled MBA Case Study Series in Accounting. Mackenzie Investments is crafting a high-yield covered call exchange-traded fund strategy to address market volatility. This innovative approach combines income generation with risk management, offering investors a balanced solution. By selling call options on high-yield assets, the strategy aims to enhance returns while providing downside protection, aligning with investor demand for reliable yield and risk mitigation. In June 2023, Prerna Matthews, Vice President of Exchange Traded Fund Product Strategy at Mackenzie Investments, identified a strategic opportunity. Investors are increasingly seeking yield and downside protection amid market volatility. With Canadian exchange-traded fund assets exceeding $350 billion, there's a growing demand for reliable income and risk mitigation, making this an opportune moment for innovative exchange-traded fund solutions. A covered call exchange-traded fund enhances income by writing call options on owned stocks. The exchange-traded fund holds equity positions as core investments, selling call options to collect premium income. This strategy boosts yield but may limit upside potential, aligning with investors' demand for reliable income and downside protection in volatile markets. Key product design decisions involve selecting the underlying portfolio, which could be broad market, sector-specific, or thematic. Strike price selection is crucial. At-the-money options generate more premium but cap returns, while out-of-the-money options allow more upside. Option expiration choices between monthly or longer-term calls affect management flexibility. Coverage percentage impacts income and upside potential. Higher call coverage levels enhance current income but restrict future capital gains. The ideal balance hinges on market forecasts and investor preferences. Mackenzie must align this trade-off with their brand and target investor risk appetite, ensuring a strategic fit with their overall investment philosophy. At-the-money options offer maximum premium income with minimal upside, ideal for aggressive income strategies. A 5% out-of-money strike balances premium collection with modest upside, serving as a middle ground approach. Meanwhile, a 10% out-of-money strike provides lower premiums but greater upside potential, appealing to growth-oriented investors. Analyzing the competitive landscape involves assessing market players, their strategies, and market share. Key factors include pricing, product differentiation, and customer loyalty. Understanding competitors' strengths and weaknesses helps in identifying opportunities and threats, enabling strategic positioning. This analysis is crucial for developing effective differentiation strategies, ensuring a competitive edge in high-dividend sectors, and optimizing returns through dynamic market coverage. Target high-dividend sectors such as utilities, energy, and financial services to enhance income potential. Adjust call coverage dynamically based on market conditions and volatility for optimized returns. Expand beyond Canadian stocks to include international markets for diversification. Integrate environmental, social, and governance screening with covered call strategies for values-based investing. Options trading demands specialized portfolio management skills, increasing operational complexity. Frequent trading and rolling positions lead to higher transaction costs. Robust systems and compliance infrastructure are essential for managing options strategies. Additionally, tax reporting becomes complex due to premium income and capital gains or losses, necessitating meticulous financial oversight. Covered call ETFs have management expense ratios ranging from 0.45% to 0.75%, with an average competitor MER of 0.65%. With Rs 1.15 billion in assets under management, projected first-year revenue is $7.5 million. The break-even timeline is anticipated to be 18 months, assuming moderate growth. Effective marketing for covered call exchange-traded funds involves clear communication of benefits and limitations. Comprehensive training programs for financial advisors are essential to understand covered call mechanics and client positioning. Targeted digital campaigns should highlight income benefits during volatile markets, while investor webinars can explain the strategy's risk-return profile and optimal portfolio allocation. Analyzing performance backtesting results reveals crucial insights into the historical effectiveness of covered call ETFs. Key metrics include income generation, volatility reduction, and overall return enhancement. These results help in understanding how the strategy performs under different market conditions, providing a foundation for informed decision-making regarding product design and market timing. Balancing income and upside potential is crucial for Mackenzie's target investors. Assessing market timing is vital. Current conditions may influence the launch of a covered call exchange-traded fund. Differentiation in a crowded exchange-traded fund market is key, alongside a fee strategy that aligns profitability with investor value. Effective education on this complex strategy is essential. Thank You and Mackenzie must strategically balance income generation with upside potential to attract target investors. Launching a covered call exchange-traded fund requires careful market timing, considering current conditions and potential shifts. Differentiation in a crowded exchange-traded fund market is crucial, as is setting a competitive management expense ratio that ensures profitability and investor value. Effective education for advisors and investors on this complex strategy is essential.